Hello and welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management, and my two co-hosts today are Jeff Watkinson of Watkinson Capital Management and Eric Parnell of Great Valley Capital Advisors. Hello, Jeff and Eric.
Hello, Mike.
Good afternoon, Mike. How are you?
Hey, doing great, thank you. Once again, we have a great group. I know we'll have more to talk about than we have time. So I'm thinking let's kind of jump right into it and find out a little bit about our views on investing and money and what people can do to maybe better their financial situation. I'd like to start, I guess, just with maybe Eric in talking in general where we're at today. This is December 2025, and we've got just so many interesting things going on in the world and in the world of finance and business. And what I see seems to be a lot of conflicting signs of higher inflation, maybe inflation ebbing, economy easing, or super strong growth. Is it a bubble? Is it not a bubble? Eric, can you just shed a little light in general on where you see we're at right now?
Yeah, no, it's been an interesting time because the cross currents continue to get stronger and stronger in this market. I mean, it's been a phenomenal run for stocks over the last 3 years, with the advent of AI and, not the advent, but the expansion of AI and all the enthusiasm around these growth stocks in the AI space. I mean, it has really carried the market along these last few years. But there's a few things that stand out that we need to keep in the back of our minds. We're looking at a stock market as we sit here in December that is very likely to push its way to new all-time highs here in the coming weeks. I mean, it shouldn't be a surprise that by the time we're at the end of December into January that we're past 7,000 on the S&P 500, maybe even getting towards 7,200 on the S&P 500. And the reason for that is that the core fundamentals underneath this market are strong. The economy continues to grow, inflation pressures remain low, and corporate earnings continue to expand. But there's a number of pockets of weakness that we need to continue to watch. We hear month after month about how the labor market is weakening. We hear about how these sectors outside of AI and tech, they may very well be in recession right now and are kind of, working through some challenges. And that threat of inflation continues to loom out there. There is no shortage of liquidity in the marketplace today. And at what point does that liquidity, whether it's low tax rates, deregulation, easy money from the Federal Reserve, at what point does that start to seep its way in through pricing pressures, which could really upend this market? So while things continue to look good, there's mounting risks that we're going to need to keep an eye on as we go into 2026.
It's interesting you talk about these different cross currents, because one of the things that I read, it's probably about a couple months ago now, one of your peers in the research financial industry, Mark Zandi, another pretty much local guy for us, was talking about right around half the states currently being in recession. And the other data point that I see is talking about the stock market activity in year to date, essentially all attributable to the AI boom and the stocks related to that, or in energy, and all the other stocks being essentially flat on the year, and also just overall economic growth, that the vast majority of that's been attributed to AI. So do you see, is that a problem, or is that just maybe we'll rotate out of that and some of these other sectors will start getting benefit?
Yeah, I mean, it could be a fascinating handoff. We see this continued growth in AI, and in particular, the CapEx spending, the capital expenditures that these tech companies are making in order to build out their AI infrastructure, artificial intelligence infrastructure. Well, one of the questions that starts to come into play is, how much CapEx starts to become too much? I mean, at what point does the spending go too far and the market can no longer support it, and we see these stock prices start to come back to earth? But one of the things that's going to be interesting to see, and I wouldn't be surprised to see this at all, is in 2026, you hear about the Mag 7 and how concentrated the market has been, all these gains in technology. Do we see a situation in 2026 where these out of favor sectors, these areas that have been in recession and they start to move into recovery, do we see a cooling off in this AI trade and the money flow back into these areas that have really been overlooked for the last few years, and where some real value opportunities have continued to present themselves?
Right. You're seeing a lot of stocks, the market non-AI trading at a 13 or 14 PE multiple, whereas the overall market's maybe 21 or 22. What do you see, Jeff? I mean, you have a pulse on it from the debt markets, the debt side, lending, municipal bonds. Are you seeing any signs one way or another there, or big transactions, or something that, new issuance side that's pointing one direction or another with what we're seeing economy-wise?
Well, the municipal bond market is healthy. Through the end of November, the basic Bloomberg Municipal Bond Index returned 4.2%. And we've already broke a record for new issuance in 2025, an annual record. And the previous record was in 2024. And that was really more of a political, actually both years with the election, a lot of states and local authorities wanted to get their financing out of the way before the election. And then this year, a lot of it was political uncertainty due to the one big beautiful bill. Will it go through? Which it did July 4th. And now we're anticipating, many are forecasting 2026 to be another year of record issuance. And really, that's great. There's new money, new supply. These bonds are coming to market, priced to sell, which means it's a lower price, a higher yield. Can you get the bonds? You put an order in for 500 bonds, Pennsylvania housing bonds, Massachusetts GOs. That deal might be 5 times, 10 times oversubscribed, but that is where the value is. And I was reading some research recently, and they're saying some of the inflation from increased construction cost is likely to contribute to higher issuance in 2026.
Wow.
Projects are costing more. Obviously, we have a growing population. There's aging infrastructure. Infrastructure needs to be rebuilt, revamped, and construction costs are up.
So you're seeing a strong demand, but at the same time, you're saying the supply, and not the supply of bonds, but the liquidity, the money available to invest in these bonds is exceeding even this increased demand for aging infrastructure to be rebuilt and things along those lines, right? So it sounds like just a lot of growth, enthusiasm all along, which actually conversely brings us to our viewer question this week. And okay. I say this because I actually wrote something last month about bubble, using the bubble word. And the reality is that a bubble might be something that occurs at the end of a bull market, but a bubble is also something where people make a lot of money. 1999 was a bubble, and the NASDAQ went up 90%. So you have people sitting there worried about bubbles at the same time that you can be making some of your best money in a bubble. But so I wanted to bring the viewer question up. This is from Frank Bolton of Philadelphia, and his question is, where can I put my money before a market crash? Okay, so his concern obviously isn't that, hey, I want to catch the upsides and all this liquidity in AI. It's how do I protect myself on the downside? And Eric, what would you say to somebody like Frank who's concerned about a market crash?
No, Frank, it's such a good question, and it's a timeless question. And to best answer that question, I'm going to highlight 2 dates from the past, October 1929 and March of 2000. And I say those dates because those are two notorious dates in stock market history, because we have the stock market crash in 1929, which was the beginning of what people remember as the Great Depression. And then there's the March 2000, which was the peak in the NASDAQ and the bursting of the tech bubble that began. And we had two grueling stock market crashes that took place in the aftermath of both of those dates. But one of the things that's not really talked about in the history as we reflect back on that is that if you look back to April 1930, or if you look back to September 2000, so these are 6 months after these notorious market peaks, investors had the opportunity to get out of the stock market very close, if not at those previous all-time highs. And that highlights an important point about market crashes, is that can we have an incident like 1987, which is something that the Federal Reserve responded to dramatically and we saw the market bounce back quickly? Yes. But if you're going to have a sustained and prolonged market crash, more often than not, the market will give you the time and the opportunity to adjust and get out. You just need to be watching for it and looking for it. So what wins out? How to position if you're concerned about a crash in today's market environment? Emphasizing quality, because quality is where markets will move first, where investor capital will move first as markets start to break down. There's 3 stages of a market crash or a bear market. There's the first stage, the early stage, where investors migrate to quality. They stay in equities, but they move to those highest quality blue chip stocks that tend to do well, if not rise, during that period. It's only in the second to third phases of a bear market where those stocks get pulled down as well. And then there's also the bond side where you can protect yourself. And even if you're in bonds and it's an inflationary environment, by going to quality U.S. Treasuries, investment grade corporate bonds, and doing what's known as shortening duration, investing in bonds that are going to mature in a year, 2 years, 3 years, as opposed to 10 years or 30 years, is a great way to protect your portfolio value while still staying invested in the market and being able to participate in the upside.
Well, Eric, I appreciate that. And it's different than a lot of what you hear in the gloom and doomers, where essentially just get out of everything. Try to anticipate market time in advance that this crash, whatever it might be, is going to occur. Try to get out of that before that actually happens. And it's what you're saying is that there usually is time. It doesn't necessarily happen overnight. And so in the meantime, and as I pointed out, prefacing the question, is sometimes these periods that come presage a bear market are some of the best performing periods for equities as well, just leading into that period. So you don't necessarily want to miss it altogether. Okay, well, thank you. And so now here's how
Mike.
Go ahead, Jeff. Yeah,
Mike, can I jump in real quick?
Yeah, absolutely.
Yeah, one of the issues we find is we're talking with clients that not only own bonds, but they also own stocks. They're also with risk on assets, stocks, and they've experienced huge gains. And a lot of these clients, it seems to be a very similar story, or the story tends to rhyme. Jeff, I have large unrealized gains in Apple. I have large unrealized gains in Microsoft, Meta, yada, yada. And where should I put my money to avoid a bear market? It's a very difficult conversation, but take some gains, pay the capital gains, do it in a consistent manner, take some winnings off the table. Easy to say on Money Matters TV, hard to say when you're anticipating your April 15th tax bill. And it's a very, very difficult conversation. And a lot of people look at their portfolio and they say, thank goodness I didn't book those gains 2 years ago, a year ago. I would have missed out on all the gains that it's very, very difficult. And I always remember the story of Sir Isaac Newton, the man who discovered gravity. And he was involved with this is in the 17th century, the East Indian Trading Company. And this was in London. The stock was ripping higher and higher. And he said, this is crazy. What goes up must come down.
Yeah.
And he got out and the stock continued to go up and up, and he booked a great gain, and then he was pulled back in to the mania. So I would really recommend being so disciplined, because you want that capital. You want that short duration bonds, cash, that dry powder.
Right. I mean, and what you show is that even a genius can be suckered into a bad decision. It's not something that's unique to just ill-informed individual investors. It happens across the board to everybody. And I wrote about this, extensively in my book a decade ago. It doesn't matter that they're an institutional investor or an individual investor. Institutional investors are just individuals with more zeros to manage. And so they still have the same emotions that they're fighting constantly. One of the things that we came on, learned about a couple months back in preparing for our launch of a new suite of ETFs is a 351 exchange. So this is something that investors potentially can participate in, where they can exchange their high appreciated, low basis stock without selling it and incurring a taxable gain. And for us, all our products have downside protection, so it's a way for people to maintain the same exposure that they have, but have downside protection added to it as well. Again, I'm not going to talk any kind of performance numbers, whatever. We can't do that on this show, but there are some options that people can take advantage of that aren't just selling out and taking a taxable hit. There are options where they can actually just transfer that, maintain their exposure, but have downside protection incorporated in that as well. Okay, so now I wanted to let you know, here's how you can send in your questions as well to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Thank you. Welcome back. So Jeff and Eric, I'd like to ask each of you separately. You can answer the question that, Eric, you do tons of economic research, market research. Jeff, you're involved, I think, in some research, obviously, as well with the muni bond markets. I'm curious as to what indicators each of you look at, whether it's just fundamental data, whether there's technical information that you're evaluating when you're looking at different markets. And Jeff, if you could just give me like the 1 minute, top view of what you look at, and then we'll move over and get a view on that from Jeff, and we can expand a little further from that.
That's a great question. We really look at the shape of the curve, of the yield curve, and that's going to dictate where we're buying the bonds. And really, our expertise, what we do every day, is try to decide. There's over 1 million different municipal bonds in the market. Is this bond priced right? What is it worth? And what are we willing to pay for it? And it's really that is the rub that we are looking at. Pricing, what is the bond worth, and what are we willing to pay for it? Okay,
so it's really using the yield curve to find the price points that you're getting paid for the risk you're taking, I guess, the best. Okay, how about you, Eric? I mean, this is your day in, day out. You're evaluating the economy and markets, and you have some go-tos that you sort of.
I'm gonna join on in what Jeff said. Speaking about the stock side. So one of the first indicators that I will also look at is the shape of the yield curve and the direction of the yield curve, because one of the things that has been a historically useful indicator is when the yield curve is flattening. And again, the yield curve, the difference between short-term yields and long-term yields, a 3-month treasury or a 2-year treasury versus a 10-year treasury. The difference between the two can be signaling to you things that are going on in the economy, things that are going on in the market, and can be a leading indicator in terms of how the market is going to perform, whether, it may go into a bear market or may actually go into a sustained bull market. So that's one of the indicators, is the yield curve, really good indicator. Some others that I like to look at, and these are indicators that you can look at home. You can simply Google them or whatever search engine that you may use. The Atlanta Fed GDP Now forecast. It's one that uses economic data to predict, how is the economy actually performing versus what you may hear on the television or read in the news at any given point in time. It's just kind of what the hard data is telling us. Another that's really useful, and again, you can look at this in a search engine, and it'll take you to these indicators, and you can find this on the St. Louis Fred databases, St. Louis Federal Reserve Bank, the 5-year break-even inflation rate. One of the things that I've been talking about is the number one downside risk for financial markets going back over the last few years is a renewed rise in inflation. And why would that be a problem? Because if inflation starts to rise again, it takes away the flexibility of the Federal Reserve to lower interest rates. It takes away the flexibility of the federal government to keep taxes low if we have an inflation problem. And the stock market doesn't like that at all. So that's another indicator I watch. And then a third indicator that I watch is what's known as, more broadly, and I'm getting back into Jeff's space here in terms of high yield bond spreads, or even more specifically, CCC rated or lower bond spreads. So if you go into your search engine, you type in CCC spreads, it will take you to the St. Louis Fred database. If those spreads are rising, that means that the market might be coming under more stress, because it means the riskiest of investors are starting to pull back. So those are just a few of the indicators that I look at.
Do you see any of those today that are signaling strength or weakness one way or another? Or are they kind of, even keel?
No, that's one of the things, you roll, I roll through that deck of different stress indicators, and they're all signaling, clear skies right now. Economic growth for the current quarter and the quarter ahead, still showing strong growth for the economy, despite those signs of weakness that we're seeing on the margins in terms of labor growth and things of that area, manufacturing activity. We take a look at 5-year break-even inflation rate. It's one that I really watch closely. If anything, that has been fading its way towards 2%, as opposed to rising towards 2.5%, 3% or beyond, which would start to be a stress signal. And even CCC spreads, although they've kind of oscillated around here a little bit, looking fairly calm, basically indicating the fact that investors are feeling comfortable with taking on risk right now. Once you start to see that hesitation with investors taking on risk, that can be an early warning sign. We're not seeing that right now, at least in some of those stress indicators we're monitoring.
Do any of those indicators at some point lead back to kind of the bubble concern again? Something I just was reading this week about hedge funds being at some of their highest leverage levels in history, which generally meant they were maybe getting a little bit out in front of their skis. Is that the type of thing that maybe things can be too good, or are these indicators, that you're seeing, if they're good, they're good? It's not that if they're too good, they're bad.
No, that's a good point. Because those are indicators that we monitor, but not exclusively monitoring those. And the reason we monitor some of those is because, like for CCC spreads, for example, or another good one, is the price of Bitcoin. Cryptocurrency is the quintessential speculator's instrument. And one of the things that we've seen going back to 2017 is that there's been a very high correlation of price performance between Bitcoin and the NASDAQ 100, where some of your most speculative AI stocks reside. One of the things that we've seen going back nearly a decade now is that if there's a pullback in the price of cryptocurrencies like Bitcoin, that'll typically happen a month or two in advance of a pullback in technology stock prices. And the reason that is, getting back to your question, Mike, is that if hedge funds have to start reining it in, they've gotten too far out over their skis, they will go and liquidate and pull back from the most liquid and the most easy to access investments, the riskiest of their investments. That's where they'll start to pull it in first.
Okay, so we did see that, right? This year, just more recently, we had the Bitcoin sell-off. It seems like it found a bottom. It rallied 10, 12% really quickly, off those lows. And that did foretell a little bit of softening, I guess, in tech stocks. It's hard to say it was a sell-off because many of them are still back at their highs. But is that what you're referring to? Is that kind of a sell-off we had, or something bigger than what just
Yeah,
occurred?
that's exactly it. We get to the beginning of October and Bitcoin peaked at 126,000 at the beginning of October, fell all the way back to 80,000 by the middle of November. That's a 33% decline that took place over a month and a half. I mean, it highlights the volatility that exists in that speculative area of the market. It wasn't until October 29th that we saw US stocks peak and those technology stocks peak. So it came 3 to 4 weeks after that peak in Bitcoin prices. What was notable is that the pullback in tech.com, AI stocks, the subliminal messaging in there, didn't intend it. Sorry about that. The pullback in AI stocks lasted from October 29th up through November 21st, but was much less than what we saw in the pullback in cryptocurrency, highlighting that price correlation, but also showing a little bit of resilience, at least in the stock market right now, that it was able to withstand that pullback in speculative activity and hold its own. Whether it does that next time, though, remains to be seen.
Yeah, so it sounds like with what Jeff's saying, what you're saying, right now we're just seeing like no real storm clouds. I mean, the normal storm clouds that you have, a little rain shower here and there, but for the most part, the economy seems like it's on solid footing. The capital markets seem to be functioning properly. You've got good liquidity. There's not a whole lot that our question right now that we had earlier in the show should be really worried about, the questioner, about maybe having a collapse or something. And it's interesting what you said, Eric, earlier, is that, okay, even if that happens, generally you have some time to get out. Now, I do want to say one thing about that. It seems like everybody thinks they're going to be the guy that gets out before it really hits the fan. And as we know, that's not the case, because the panic selling occurs at the bottom. It's what puts the bottom in. It's not at the top. If everybody did that at the top, there'd be no bear market. There wouldn't be continued selling. So obviously, people have to have the discipline to recognize that, okay, I've got an opportunity now to get out of this. And some of these other indicators that you're looking at might indicate that now is the time. Not today, I'm saying. Yeah, Jeff, I was going to ask you about the yield curve as well. I mean, is that telling you anything as well?
The long end of the yield curve remains steep compared to the lower end. The market repriced at the end of September. There was about a 50 basis point move from the long end. It's still, that is where the value is. Bonds 25, 30 years out, priced to a 9 or 10 year call. That is where the yield is. The indicator that I like is the sentiment. They say stocks climb a wall of worry, and I look at the AAII.com sentiment survey, and there's plenty of worry out there for stocks. Mm-hmm. So that's, since I'm a contrarian, that's no sign.
And I see that as well. I haven't been able to find any really great correlations one way or another with AAI data. I'm not sure why. Okay. And historically, with Investors Intelligence or some of the other sentiment indicators we use, they would have a reasonable correlation, generally inverse correlation. We've got one strategy that looks at ETF money flows into speculative ETFs. And if you see a lot of money flowing into the most speculative ETFs, you're near a short-term top, the majority of the time. Jeff and Eric, thank you once again. And thank you as well, the audience, for watching Money Matters TV, where your money matters. We'll see you next time.